My name is Jake, welcome to the channel. In today's video, I'm going to show you how to make an 8.75% dividend yield with SCHD. Now, a few weeks ago, I made a similar video talking about this strategy by using a company like PepsiCo. In that video, I showed you how you could turn a 3.8% yield into an 11.5% yield with PepsiCo. A few people commented that they liked the idea, but they were just not comfortable doing it with an individual stock. So in today's video, we're going to do this with the same strategy, but on an ETF like SCHD. I'm excited to share that this video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to analyze my dividend portfolio. You can check them out with the link in the description below and use promo code DGI to get the very best pricing. So I'm going to go a little bit less into the details on what a covered call is, but rather dig deeper into the details of actually doing this, doing a covered call on SCHD. So if you're unsure of what a covered call is or how it really works, I would highly recommend watching that other video where I talk about, the strategy of writing a covered call on a company like PepsiCo, because I go into a lot more detail on the covered call side and helping you to understand what it actually is. This video is building upon that information that we learned in that last video and taking it a little bit, a step further and understanding the math a little bit more and how you can look to do this yourself. So in this video, I'm going to show you how you can create your own covered call ETF with a real example using SCHD. Now, I know another video on SCHD here on YouTube. This will be my second video on SCHD here in 2025. So cut me a little bit of slack because trust me, if I wanted to milk this system and milk YouTube for views, I would just make videos on SCHD or some other high-flying trendy investment. That's obviously not what I do. So with that out of the way, let's take a look at it. But yeah, so who may want to consider something like this? This is ideal for someone who wants to generate a little bit of a higher yield with their cash, but they don't want to tie it up in a CD or in a higher risk, risky investment. This is a great strategy for someone looking to park their money, or at least some of their money, for a year or so and want to generate a higher return than a CD or a high yield bond or a short-term treasury. Now, I want to be clear that this is not a one-to-one replacement for a cash account or an emergency fund, because it's not. This is, not without risk. This is for someone who is comfortable with a little bit more risk in order to generate a higher yield. But I do want to say that this goal or this approach is not to generate the highest potential total return. Okay, so we're not looking at total returns with this approach. This is purely just looking to generate a higher yield with minimal risk. Okay, so with that said, we're all on the same page, not for total returns. This is just to get a higher yield, right? So SCHD has like a 3.8% yield. How can we more than double that yield without taking on a lot of risk if we're just looking for the income? And because we're going to drill into the numbers so much, this may seem a little overcomplicated, especially if you're new to this, but I promise it's not difficult to learn if you take the time to learn it. But despite saying this, I'm sure some of you out there are going to look at this and think that this is way overcomplicated, and you're probably going to say that it looks a little like this. Gosh. Oh, when the baby went and grabbed it, that's when it got me. Oh man. So we got Halloween, coming up here on Friday. I usually record my videos either on Friday or Saturday. And with Halloween, I'm recording it a little bit earlier so we can take our son Lucas out trick-or-treating. Last year, he was a little pumpkin. This year, he's a little ghost. So excited about that. But we're going to take a look at an example based off of the numbers from Wednesday. So when you're watching this video here on Sunday or whenever, it's possible that the numbers are different, and that's completely fine. We have to use assumptions because the dividends have not yet been declared. So I'm estimating for future dividends for next year, but I'm going to use pretty, conservative numbers, basically zero growth for next year. So in reality, the return will actually probably be higher, probably closer to, a 9% yield, but I'm just going to use a little bit of a conservative number. We're going to assume that you got 2,000 shares and you have 2,000 shares of SCHD, each at $26.75. Let's just use that number. Those 2,000 shares cost you $53,500. This is just an example. Whether you have 100 shares, 5,000 shares, 1,000,000 shares, it doesn't matter. What we're focused on in this example are the percentages. So you got 2,000 shares at $26.75. What you're going to look to do is you're going to take those 2,000 shares and you're going to write what is called a cover call. And you're going to have different options when you're looking to write a cover call, but we're going to look at the January 15th, 2027 contract. And with that contract, it's currently going to be paying you $1.55 per contract. And each contract is, 100 shares. So you might be asking yourself the question, well, how did Jake come up with this $1.55 per contract? Well, it comes down to the options chain and what people are paying for the options. So if we take a look at the expiration for January 15th, 2027, and we take a look at, the $27 expiration. And so right now there's a spread between 145 and 165. And so if you take the middle range, you're going to get 155. So if you were to go today or tomorrow, and if the share price didn't change a lot, and if you wanted to sell a covered call for January 15th, 2027 for the $27 strike, you could generate $1.55 per contract. So you can find out this information on a website like this, or you can go into your brokerage. If you have options enabled, you can see what it would be paying there. If you were to go into your brokerage, you could take a look at it like this. I'm just showing this here in Robinhood as an example. If you were to pick the January 15th, 2027 date, that's over 1 year into the future, okay? Now, they don't have one for September or December, so I'm using the one here in January. If they did have one in like September or October, I probably would have used that one. But with SCHD, they only have the one here for January. And what you're going to want to do is you're going to want to click on this here. So when you click on the $27, you're going to type in 20. Remember, there's 100 shares in every contract. So we got 20 contracts for 2,000 shares. And you're going to see this bid spread here with the $1.45 or the bid ask, $1.45 and $1.65. So we're going to take right down the middle and put $1.55. So in order to do that, or when we do that, we're going to get a credit of $3,100. Okay, so you take that 155, you times that by 100 shares, and this is what you're going to get. If you had 2,000 shares, you're going to say, all right, I'm willing to sell these 2,000 shares at $27 on January 15th, 2027. In return, I'm going to receive $3,100. But you're also going to receive the dividends from now until then. This is just the premium. So when we're calculating that 8.75% return, it's a combination of the dividend and the premium. So to summarize it here really quick, so you're taking 20 contracts and you're getting $3,100 paid up front for obligating yourself to, write this cover call into the future. In addition, you're going to get about $1.30 per share over the next 5 dividend payouts. Now, this $1.30 is just a mere estimate. I'm just assuming no growth over next year. It's probably going to be more than, I hope, I hope it's more than $1.30, but just taking a conservative number, you're going to get the dividend payout for December of this year and for the next 4 quarters. So you're getting 5 dividend payouts. So you take 2,000, you times it by $1.30, and that's going to give you $2,600. And this is assuming that you're holding this until the expiration of January 2027. So you take the $3,100 premium plus the $2,600 dividend, you're left with $5,700 in income based off of your capital of $53,500. An annualized return, you're going to get just under 9%. So with this scenario, let's take a look at a few examples. So there's 2 possibilities when you make this trade. So the first possibility is if SCHD is above $27 on January 15th, 2027, you are forced to sell your shares at $27 per share, and you keep the $3,100 in premiums and obviously the dividends as well. You will also generate a long-term capital gain of $500 because your cost basis was $26.75 using the example here. The second possibility is if SCHD is below $27 on January 15th, 2027, you keep your shares and you keep the $3,100 premium and the dividends. If this is the case, you'll be left with the question to either keep your shares, or you could also repeat the process and write a new cover call and generate a premium while also collecting, the dividends along the way. Those are the 2 possibilities. And really, there's no good or bad because you understand the situation. You understand the 2 possible outcomes and you're okay with either outcome. And if you're okay with either outcome, you want some extra income, this could be a great alternative to generating a little bit more income versus a CD, a bond, or maybe a more speculative high dividend stock like a SIN stock, or even a cover call ETF like JEPI. You're going to generate a higher yield with this, with SCHD, than with JEPI. So very, very interesting. Now, I know a lot of you are going to take that $5,700 and simply divide it by your cost basis of $53,500. And yes, you can do that. But when you do that, when you're doing a cover call like this, you want to take this and you want to look at the annualized return and not your transaction return. Let's take a look at it and understand basic transaction returns versus annualized rate of returns. Whenever you're working with options, I always recommend take a look at the annualized rate of return. The reason why the annualized rate of return is important is because there's something called time is money. Have you ever heard that phrase? Time is money. This is absolutely the case with options because what you're focused on is, well, what is the alternative when, investing into a bond, a CD? What you're interested in is the annualized rate of return when it comes to options. At least that's how I personally look at it. Let's take a look at an example of a transaction return. With a transaction return, you're taking the total income and you're dividing it by the total amount invested. So you take the $5,700, that's including the dividends and the premium, and you're dividing that by $53,500, which you originally invested. That will give you a transaction return of 10.7%. Okay. Now, when we look at an annualized rate of return example, you take the 365 days, you divide it by the days till expiration, and then you times it by the transaction return. This is how I do it. Maybe there's another way to do it, a simpler way. This is just how I've always done it. And so using the same example, you take 365 days, you divide it by 443. That's based off of the transaction date from Wednesday of this week. And you times it by 10.7%, which gives you an annualized rate of return of 8.78%. So the example here that I shared is with all real numbers based off of Wednesday's share date, the price of SCHD, and the assumption of the dividends, that I made as well. Income investing can take many shapes and sizes. There's no one size fits all, and there are definitely pros and cons to this approach. So let's take a look at some of those pros and cons. The first pro is you lock in that 8.75% annual return in terms of the income today. You're locking in nearly a 9% return with SCHD. Another pro is it protects you against a bear market. Or if you think that the market's going to be red in the next year and you want to hedge against the odds of a recession, this can be a great way to hedge against a recession. Now, it's possible that the share price of SCHD goes down, right? But it's a good way to hedge if you're going to keep the shares anyways. Another pro is that there's less risk with SCHD and doing this strategy than with a single stock. So you don't have the single stock risk with this. Another pro is that 46% of the income is a qualified dividend. Now, this is important when you compare it to, a covered call ETF like JEPI, where about 90% of the distribution from JEPI is non-qualified, and thereby, only 10% is qualified. When you compare this to other covered call ETFs, this is actually, from a taxation standpoint, attractive alternative to other options out there, especially if you hold this in a taxable account. But just understand the other percentage, the other, majority is going to be non-qualified. And another pro, when talking about taxes, is that the tax burden is spread out across 3 tax years, but paid, by the following year in April. So even though you get the $3,100 or 54% of the income up front, you're not paying that income for many years to come. Now, let me break this down year by year. So you're getting that $5,700, but you're not getting it all at once. So the premium you are, but not all the dividends. So in 2025, you're getting $540, assuming you have the 2,000 shares, or just under 10% of the overall income, right? But 100% of that $540 is qualified. That's, assuming that we have a, 27-cent dividend here in December this year. Who knows if it's 26, 27, but that's just how you look at it. In 2026, you're going to have $2,060 or 36% of the income, the total income, which will all be 100% qualified because it's just the dividend. Now, this is assuming $1.03 in dividends, right? It's probably going to be different than that. Hopefully it's more than that because they raise the dividend, but I'm just using more conservative numbers. And then in tax year 2027, you get $3,100, which will then be taxed, or 54% of the overall income, and 0% of that will be qualified. And we got that $3,100 from the $1.55 premium that we generated all the way back in 2025. But it's important to understand, you're going to get that in January, but you won't pay taxes on it until April of 2028. So if you really want to spread out your tax burden, this can be a great way to generate the yield and the income, but delay the tax payment, right? So it's important to understand you will be taxed, but it'll come much later. And it's worth mentioning, obviously, that these numbers will scale up based off of how many shares that you actually have, but the percentages will stay the same. So now let's take a look at a few of the cons. The first con is that you're obligating yourself to wait out the trade regardless of what the market is doing. You can change your mind along the way, but it may end up costing you to close out the trade early. So you want to remember, when you're doing this, you're obligating yourself to wait it out until January 2027. There's a reason why you're receiving that $1.55 in premium today is because nobody knows what the market's going to do in the future. You're getting paid to wait it out. It's important to understand that you want to look at this more as an obligation, though you can change your mind, but it's possible that you could lose some money on it. Another con is because we're doing this over 365 days into the future, the returns with the premium are slightly lower had we done a shorter time period? And that's what I was referring to earlier. If the options were, if there was an option available to do this for September of next year, October of next year, I would much prefer that, though the tax implication would change, right? Because it's then next year instead of 2027. But just understand the longer that you go out, the percentage of the return will go down. Another con is that there's always the possibility that if the shares of SCHD go up extraordinarily fast, that they could be assigned before the expiration date. Now, this is unlikely, but it is possible. This tends to happen more with individual stocks and less with ETFs. So I personally wouldn't really worry about this, and especially with an ETF like SCHD where the volatility is generally very, very low, I wouldn't really have this on my radar, but it is a possibility. Another con here is the upside is capped in a bull market. The share price of SCHD may skyrocket above $27, thus resulting in a lower total return. This is always the case with covered calls, so it's important that you want to make sure that you understand why you're doing this. And this is why I stressed so much at the beginning of the video that this is for income. This is not for capital appreciation. So anything and everything above $27, you are forfeiting that growth in return of receiving that, receiving that $1.55 in premium as an example. Anything above that $27, that's not your money. Okay. You're doing this trade because you were satisfied with the rate of return that we discussed here. And if you weren't satisfied with it, you obviously wouldn't do it. So just understand the real risk, the real con is if SHD goes up to like $35 or $30, who knows what it's going to do? It could go down to $20. You just never know. But if it were to go to $35, you'd be like, ooh, man, I should have just kept it. But then it wouldn't have been for income. It would have been for growth. And if you want growth, why are you investing into SCHD, right? So it's like you really want to weigh, the reasoning behind or the rationale of why you're doing this. So just understand that the real risk here is with the share price greatly, appreciating above that price of $27. And then the last con here is that 53% of the income will be taxed at a higher rate and classified as ordinary income. But, considering the alternatives like JEPI and these other covered call ETFs, this may actually be a pro. So it just depends on your strategy, your goals, but just understand that the premium that you're generating here, it will not be a qualified dividend. It will be an ordinary income. So you're going to be paying higher taxes on this. Someone might be thinking, well, Jake, I'm holding this for well over a year. That's, long-term capital gains. What's the point of that if I'm going to, pay short-term capital gains, right? Even though I'm holding it for longer than a year. That's just the reality of these covered calls because it's not a dividend. It's a distribution. And distributions, in this case, are taxed as ordinary income. Covered call income is always taxed. Covered calls, cash secured puts, they're always classified as ordinary income. So it's just important to understand that. And that's why I've said, I'm saying this for the third time now, if the option were to be available, or if it would have been possible to do this in September or July or August, something like that, it would have been under a year. The premiums probably would have been higher. I probably would have done something like that. But it's not available today, so I'm using the example that it's available. So this is a real example. There's pros and cons, but I think if you come back to the original statement that I made, that this is for someone that has a little bit extra money on the side. They don't want to put it into a CD. They don't want to put it into a bond. They want a little bit of a higher return. And this is a way that they could do it. They feel comfortable owning SCHD, but they don't have to keep those shares. This is a great way to double your income with a covered call. So everybody, that's how to make an 8.75% dividend yield with SCHD. But yeah, I'd love to hear your thoughts. If you haven't already, go check out Snowball Analytics. And thank you so much for watching. And I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.